All right. Welcome, everyone. Really appreciate you joining. This is our first live stream. So, we're really excited about having you here. We're going to talk a little bit today about taxes, the new administration, and what that means for you guys as investors and retirees. So, I think it's really exciting to learn the potential opportunities that are out there and maybe understand what you want to do with this new administration. Excuse me. So think a little bit about, we talk a lot about emotional investing and how that can really hurt so many of us. And I think it's really important to consider that emotions don't have a place in investing, right? That's one of the reasons why we don't want to let political decisions. We all tend to be pretty emotional about political decisions and what we want to do from that regard. And we don't want to let our emotions get caught up there. That's why it's really important to find a fiduciary. Or if you're handling things yourself, you really want to take the time to make sure that you're understanding what's going on in your accounts and not letting those emotions rule the day. So I'm excited today. I have a CPA. Our CPA is here with us today. His name is Brad Vogt, and he's with a firm called RPB. For those of our clients, you know RPB and Brad. They do taxes for dozens and dozens of our clients, and we're really excited to have him here today. Couple quick things while he's getting logged on I want to cover is really this idea that we are likely in the lowest tax rate environment that we may ever see in our lifetimes, right? What do I mean by that? Whether you liked President Trump and voted for him or not, right? We have this tax cut that went through several years back, and it brought the rates down. Now, regardless of the new administration, we can talk a little bit about President Joe Biden's proposals and what he's talking about doing here. But regardless of those proposals, even if that doesn't pass, right, one thing we're waiting to find out is, will the Democrats vote as a group? If they all vote as a group, we know in the Senate, Vice President breaks the tie, so they may be able to get some of these things through, but we don't know yet if they're going to vote as a group, so all we have to look at is his proposals. So when we look at those proposals, there are some substantial increases in tax rates, taking away a step up in basis, really lowering the state tax exemption, a lot of things we'll talk about today. But even let's say none of that comes to fruition, right? We already know that in 2025, at the end of the year, the current tax cuts for individuals automatically index back up. So we know rates are going up even if no new bills are passed, right? So many of us have saved so many dollars in this pre-tax retirement accounts. And we simply have a big, we have a silent partner. We have a big IOU from the IRS. So we want to figure out what's the best way, not just for this year, right? Some of you may have tax preparers, and these men and women do great jobs, but many of them act as historians, right? They're looking back one year to say, what's the best deal I can get you on taxes this year? Well, I'm going to make the argument a little bit that maybe we're better off paying a little bit more taxes this year and in the coming years before the rates potentially go up. Maybe some of you have worked really hard and put a lot of your funds into these pre-tax retirement accounts. Maybe it's a 401k, 403b, 457, and you did great saving, right? And most of us, mom, dad, aunt, uncle, grandma, grandpa, somebody said to us, look, put as much as you can in that pre-tax retirement account, because when you retire, you're going to be in such a tiny tax bracket, you'll barely pay anything, right? But for many of us, that's just not the case, right? I can't tell you how many families I've met in their 70s that have run into some issues where they say, boy, Tony, I have a pension. I know we don't all have pensions anymore, but they say, Tony, I have a pension. I have my Social Security. Now Uncle Sam comes knocking at 72 and says, hey, time to start taking money out of that retirement account. Why do they make us do it? Because it's taxable income, right? They get to keep a portion of it. So some of us end up not being in a lower tax bracket. Now, that's going to be different for every family. Couple resources for everyone today. If you look in the comments or in the description, depending on how you're watching us today, and I appreciate everybody joining. This is our first live stream, so we've been really excited to get this going. But if you want some additional resources, I have a link there in the comments or the description on a tax planning guide for 2021. There's also a link if you have a question. You want to set up a complimentary phone call. On Facebook, you can go into the upper right corner and click that Book Now button. A calendar will pop up. You can pick a time that's convenient for you. That's completely complimentary. If you're joining us on YouTube, if you look at the description of the show today, you'll see a link to get that as well. So really excited to connect with some of you folks and be able to have a great conversation. But I think this idea of tax planning is often kind of mistaken or not looked at. When I think about, boy, I don't know, thousands and thousands of plans that I've reviewed over the years, tax planning is one of those issues that's probably one of the main things missing that people just don't fix, they don't address, they don't think about, right? But taxes can be one of the largest expenses in our portfolios, right? It can be a tremendous, tremendous expense. So we want to make sure we're addressing that and thinking about it, right? Think about it later in life. You know, now you're retired, we don't have the income that we used to have, and suddenly you have to start taking money out, right? You have to supplement your income. Maybe you're fortunate enough to have a pension, maybe you're not, right? But for those of us that don't, maybe Social Security is not enough, we need to take money out monthly of our portfolios. There's nothing wrong with that. That's why you've worked so hard and saved it in the first place. But if we're taking that out inefficiently, it can really make a difference. And think about it down the road, as tax rates start to go up, right? We have a tremendously growing budget, or a deficit, excuse me. You know, when we look at the money that we're spending, we entered last year with over $20 trillion in debt, right? In March, pandemic hit. We added a couple trillion with the CARES Act, just shy of another trillion at the beginning of this year, and they are debating as we speak another 1.9 trillion, right? And if we listen to the Treasury secretaries, doesn't matter which side of the aisle, Stephen Mnuchin or Janet Yellen, they're saying things like now's not the time to worry about the debt, which arguably might be true. But my concern is, especially for my retirees and the families that we work with, is when the government decides it is time to deal with the debt, then what happens? What do we do? That's where we run into some major, major issues. So I want to make sure people are prepped for that and putting some tax planning strategies into place. When we think about these strategies, we often think about three different types of taxable buckets, right? You have your retirement accounts, that's your 401ks, IRAs, 403bs, 457s, maybe you're a retired federal employee, you have a TSP. Those all went in pre-tax and payroll, or you got a deduction at tax time, but they grow tax deferred. What does that fancy word mean? Just means we don't pay any taxes, we can buy and sell in the account. But then when we're in retirement down the road and we start to take money out, it's all taxed for most of us at that unfavorable type of tax, which is called ordinary income. That tends to be a little bit higher than the other types of taxes. The second type of tax we look at is called capital gains. Now, this could be short-term capital gains or long-term capital gains. These tend to come from accounts that you have titled in your name or maybe jointly with you and your spouse, or maybe it's owned by a trust. Right? There could be a number of different ways we're titling these accounts. And as long as you hold those equities or positions for a year or longer, you get this preferred capital gains rate. For most of us, that lands right around 15%. Again, I'm not the CPA, and you want to make sure you look at your own rates because there's different brackets. But that's a little bit preferred rate versus the ordinary income. Then the last bucket, this is my favorite. This is the tax-free bucket, right? We're talking about Roth 401ks, Roth IRAs. Let's say that together. Tax-free. It just has a nice ring to it, doesn't it? And these accounts are accounts we put money in. At the time we put the money in, we did not get a deduction, right? But it grows tax-free, comes out tax-free. That's a pretty amazing tax benefit. I have yet, for one of my retirees that's taking money out of their Roths to supplement income in retirement, nobody's ever said to me, boy, Tony, I wish I was paying more taxes on my income, right? It just doesn't happen, right? Nobody wants to pay more taxes. So it's really important to think about that tax diversification, right? So many of us, and it's not your fault. I mean, I met so many families that are great savers, but the vast majority of their wealth is in that first bucket, that ordinary income tax bucket, which we know is going up in 2026, maybe even sooner with the new administration. right? And so much of your wealth lands there. What do we do? Well, one of the things we can think about is starting to diversify. Maybe we're better taking some money out of that first bucket, converting it to the tax-free bucket. Yes, we have to pay taxes in that current year, and you don't want to do it all at once. Frankly, your income would go so high, I don't know, a gentle way to say it, we probably never live long enough to make up for the tax bill, right? But if we can kind of control that, do some simulated tax returns, get the accounting team to help us and figure out how much we can roll over each year without pushing us up into a bracket that's too high, I think we're going to look back on that and say, boy, we made a pretty amazing decision, right? We're going to look back on that and say, boy, now that's grown tax-free is coming out tax-free. And when we converted it, we paid a pretty low rate compared to rates down the road, right? And for those of you, I meet so many families that say, Tony, it's important for us to pass money on. What we don't want is for the IRS to be the largest beneficiary, right? One of the things we saw in a law change at the end of 2019, we had a great preferential thing for beneficiaries. Let's say you inherited mom or dad's IRA, you could put that into what's called an inherited IRA, or the slang term is a stretch IRA. And you only had to take out a little bit of tax each year based on your life expectancy. That's where the word stretch comes from. You got to stretch the tax liability over your life expectancy. That's now gone. So in that law change, they did give us some things. Instead of having to take money out of our IRAs and 401ks at 70 and a half, we get to continue that tax deferral till 72, but they took away that stretch IRA. Now beneficiaries only have 10 years. Over that 10-year period, they have to completely cash out that IRA or 401k. Now, depending on their income, maybe your daughter and her husband have a decent income already, and now they have this additional income they have to cash out over 10 years. That could put them in a pretty high tax bracket, and that could make Uncle Sam one of the largest beneficiaries. So that's something we really want to try to avoid. In particular, if you're looking at your accounts and the projections are that, you just can't, you just aren't going to spend it all, right? I mean, so many families like that are just not going to spend all the money, right? It just doesn't happen. And we can simulate stress tests, look at up markets, down markets, spending more, maybe getting that second property down south or renting down south because you're kind of tired of the cold winters or whatever the case might be, and they're still not projected to spend all their money. It's really important we think about legacy. So many of our families are concerned about connecting, making sure their spouse is taken care of if they pass away first, and making sure the IRS doesn't become the largest beneficiary. So starting to shift and have some what we call tax type diversification can really benefit us in the long run. Because if we're trying to implement some great tax strategies, we may want to change which accounts we're taking income out of in which order. Sometimes simply we meet a family and by just changing the order that they're taking their income needs out of can add a tremendous amount of longevity to the portfolio. So we have to understand that and we have to think about that. And I think the other piece that's really important when we think about different types of taxable accounts, and I'm going to make somewhat of a blanket statement here. Remember, I'm not an accountant, I'm not a CPA, so you want to make sure you connect with your CPA and your accounting team before you make any decisions and change anything that we're talking about today. But you also want to align your risk or think about aligning your risk and see if that makes sense for you and your family. What do I mean by that? Well, so many people just don't think about risk alignment and what they want to do from that regard, right? Think about it. When we talk about that first bucket, that ordinary income tax bucket, for most of us, probably the higher tax rates, the rates we know, again, are going up in 2026, right? When we think about that bucket, if we think about our assets in different risk categories, right? A real popular kind of strategy is the 3-bucket method, right? You have the low-risk portfolio that you're taking income from right now because you need it now. You can't afford losses. We have that mid-range risk, maybe a moderate risk portfolio for our longer-term dollars. And then we have that last bucket that's either money we think we're never going to spend or money we think, we don't need for, 20 years plus, right? Really far down the road so we can take some more risk. Why are we able to take more risk? Simply because If it drops, we don't need it in the short term, so there's time for it to recover, right? If we think about last year, when the pandemic hit, we literally had the fastest loss in history, faster than the Great Depression, but we also had the fastest recovery period, right? So if you had a high risk portfolio in that long range bucket and it dropped 30% pretty quickly, you also saw a tremendous recovery by the end of the year. And things are still plugging along, right? So balancing that risk is important, but a lot of people then don't connect the dots. When we talk about tax diversification, which risk bucket do you want in each category? Well, I'd make the argument for some of us that our low risk, our immediate needs, depending on the tax strategies you're implementing, might be best in that first bucket. Why? That bucket, every dollar that comes out is taxable. Why not have our growth in there that's a little bit more limited, right? And then we put our moderate investments in that non-qualified or that preferred short-term or long-term capital gains rates. And then we look at the last bucket. That's our growth. We're going to expect to see good returns on that account over the years. That one, let's put in the Roth. Why? Grows tax-free, comes out tax-free. So when we have that bigger growth of all three buckets, that one comes out tax-free. That's really, really important. So we not only want to think about tax diversification, we want to think about risk diversification, and then which risk buckets do we put in which tax buckets? Really, really important. Number one question I get by far when people come into the office or to one of our classes or join us digitally here is they're saying, Tony, do I have enough money? Am I going to be okay? It's really a question of longevity, right? And what people are really asking, whether they realize it or not, is, am I going to have the income I need to deal with, rising inflation, rising taxation, rising healthcare costs, right? We've all heard some of the myths, and if you tune into my radio show a couple weeks ago, we played Mythbusters, right? But one of my ones that just drives me nuts is they say, as soon as you retire, you're only going to need 70 to 80% of your pre-retirement income. Well, ask yourselves today, how many of you want to spend 20% less the day you retire? That's just not reality, right? For most of us, for most of the families I worked with over the last 19 years, what I've seen is generally there's an increase, right? Generally, there's more spending early in retirement. Why? Well, suddenly you have the time. You want to do the things you saved for and dreamed about, travel, whatever it might be. Right? And then we tend to see a little bit of a reduction in the budget down the road. So first it increases, then a reduction. You've done the big trips, you've done some of the things you dreamed about. Maybe the knee hurts, the hip hurts, whatever the case might be. You're just more comfortable at home. You want to work on the garden or the hot rod in the garage. So then our budget tends to come down. Right? And then later in life, of course, it goes back up with healthcare expenses that we deal with as we age. So I think that income plan has to be much more dynamic, but the tax piece plays a really important part of that. And I think it's something that often gets overlooked. We ask a lot of people, and I challenge you to ask yourself this today. How many of you feel that you have a retirement and income plan? Here's the caveat that you understand. Retirement and income plan that you understand, right? And think about that question for a second. And if you're saying, no, I don't think I do, you're not alone. Generally, not nowadays, right, with the pandemic going on, but generally when we're talking in front of a large group, let's say 40 or 50 people, and doing an educational talk, very few hands go up, right? Very few of us believe that we have a written retirement and income plan that we understand. And that should really address 5 areas, right? It should address investments. And I think that's where a lot of advisors start and end, right? They want to talk about their average rate of return and how great their funds do and all that great stuff. Important part of the conversation, but it's a piece of the conversation. If you're working with a fiduciary or a holistic planner, we also need to look at some other areas, right? What's your risk like? Right? How are we going to deal with rising healthcare costs? Right? How do we protect the family, that spouse, if you pass away first, or making sure, taxes, that Uncle Sam isn't the largest beneficiary? We really need to incorporate all 5 pieces of this puzzle. Becomes really important to have a comprehensive retirement and income plan. So again, as we wrap up here today, I wanted to keep this brief. I know everybody's busy during the day, but a couple opportunities for you. If you're watching us on Facebook, If you go to the upper right-hand corner of your Facebook page, you're going to see a Book Now button. You can book a complimentary 15-minute phone call. Or if you're interested in a complimentary written and retirement income plan that pulls those pieces together, and our goal is to turn the light bulb on for you so you feel like you really understand how the pieces are working together, you can book a longer 60-minute consultation. Those are completely complimentary. Or if you're joining us on YouTube today, if you look at the description in the video, you'll see those links to connect with us as well. I really appreciate everyone joining us. This was our first live stream, so we're really excited to bring you the information, and we'll look forward to connecting with all of you. Again, whether you just simply want a tax analysis, have a quick question, or really do want that complimentary written and retirement income plan, click that Book Now button, and we'll look forward to connecting with you. Thank you all so much for joining us.